Welcome to the InterMarket analysis video update. This is a weekly video looking outside of just the S&P 500 at other indexes within the stock market, at other markets, to see if we can get some insight as to what's happening with the S&P 500. Now, if you watch these videos on a regular basis, there's no changes this week from last week and the week before and the week before. There's one that is potentially close, and I'll show you that later on. And I go through a number of different areas in this particular video, and it's being prepared for Monday, October 13th. The first area we look at is valuation. And we've been overvalued for years now, but whenever we start to go down a little bit, it's like that's the red flag that everybody points to. But I don't use this as some kind of timing mechanism. We know it's overvalued historically and even looking forward, but it doesn't seem to matter. And then at some point, it might. But even when we go down, valuations can still stay pretty high. We also look at growth versus value. Now we're seeing some short-term weakness in there. The market, since the beginning of August, has been drifting a little bit more defensive, and that means that we're shifting to possibly go down. But we've been going up. Now, is that shift that's gradually been taking place, is that going to lead into something a little bit more? That's why we look at these growth versus value ratios and charts, because when the market's really going up, growth is outperforming. When value is outperforming, that means the market is defensive and typically going down. We also keep an eye on inflation, which we have the government shutdown, and we're probably not going to get CPI and PPI this week. But there are also other charts that we look at. And just like I've been pointing out the last few weeks, there's one inflation chart, but it's proprietary. It's not something that the market looks at in the whole, but that one's giving us a little bit of a concern, but we're really not seeing that in other areas as far as inflation. And then we look at other markets outside of the stock market. We look at the 11 sectors for the S&P, and we look at a number of different indexes and then different correlations between markets. We look at some very long-term trends, mainly monthly charts for that. And then I have a positive and negative list. And as I said, there's no change in this list at the very end. There's one that's getting really close. All right, so valuation, what we've been seeing now for quite a while, even though we're pulling back a bit in this last week with the S&P, we're still well above this red dashed line, which is a PE ratio of 20. And you can see, even when we go down, the market can still stay overvalued, or if it drops down below 20, it tends to not stay there very long. This also shows what valuations have been historically over time, and it's not strange for the S&P to go years above the red dash line. This also is a variation of that. Even though it declined a little bit with the Shiller PE ratio, we're still coming in at 39.09, which is more than double of the median and mean between 16 and 17. We've been seeing the same reading now for years. This is looking forward with forward PE ratios. And even though we dropped here with the purple, this is the Mega Cap 8, Magnificent 7, Illustrious 11, whatever group you want to put them into. This chart is put out by Edward Yardeni, and he's put them into 8, where most people look at 7 here. We just call them the Mega Caps. And even though it did decline, we're coming down from below 30. And again, with that 10, 15, 20 scale, we're still overvalued. And even when we went through the bear market in 2022, you can see we were still getting very high valuations here, even when you look forward at earnings. We are dropping a little bit, but still pretty high with the S&P coming in at 22.1. We're above that 20 level and have been now. And we did see some weakness in small caps and mid caps. And so they're dropping back down. They're more fairly priced with the small caps at 14.9, the mid caps at 15.7. And this is another way to look at this, because this tries to detrend things and say, okay, how far away are we getting from a standard deviation type of measurement? The problem with this is it's a combined PE ratio. It's the trailing 12 months, the forward PE ratio, and then the PE 10, which is the Robert Shiller. It puts them all together. So we're getting backwards, forwards, and different variations all taken together. And this also shows that we are overvalued. But That's not why the market goes down necessarily, because the economy is still doing quite well based on what reports we have been getting. We're seeing GDP going up, inflation doesn't seem to be a problem. It looks like the Fed's going to be coming in and cutting rates at the end of October and then again in December. And so it's the cuts are just to tweak the economy. And it's really if we go into a recession or not, that's when earnings are really affected. And the market is assuming, based on charts that we also look at, that I cover in other videos, that we're not going to go into a recession. But even though this shows that we're overextended. All right, so first we go through growth versus value. We first look at a chart of growth. Yeah, taking a bit of a hit, dropping down below its 50-day moving average. Everything got hit on Friday, with this index being down over 3%, also dropping with value. Okay, so it was like, let's take out everything and sell it on Friday, is kind of what happened. It's also dropping below its 50-day moving average. So when you look at ratios between the two, still looking pretty solid. Growth is outperforming value on the bottom, an inverted version of this ratio. We're seeing how value is underperforming growth. And we look at ETFs. Growth is still outperforming value. Value is still underperforming growth. Indexes. Growth outperforming value. Value underperforming growth. We're seeing confirmation as we look at a number of different charts, different time frames, different ways that these either ETFs or indexes are calculated. We just want to see if we're seeing the same thing in many areas. This also is looking a little bit weaker here, but we're still at the top end of the rainbow with the growth to value ratio here. This is also showing it's an inverted version of the previous chart, how value is still underperforming. Then we look at small caps, and they actually saw a bit of strength earlier on in the week, and we were seeing a real improvement with the small cap growth to value ratio. Now, we did just generate a death cross with this ratio because we were going up with the small caps and we were going up here, but then we just leveled out as small caps were still trying to go up, and then small caps were going up again, and we saw a negative divergence with this ratio going down. Now, it was improving, but then it got hit on Friday with everything else. This is probably the best growth to value ratio right now, or the mid caps. Uptrend, we did fall back, showing some strength. On Thursday, it broke out to a new all-time high, but the index is going nowhere. And then it dropped with everything else on Friday. So we're seeing internally where growth is outperforming, but we're just not seeing that reflected in the index itself. This is the one that I pay attention to. It was a little bit encouraging. We were trying to get back above this 50-day moving average with the S&P growth to value ratio. Well, we dropped down a little bit below it on Friday. And we're still in a longer term uptrend, but you can see right about when we topped out at the beginning of August, that's when we started to see the market turning a bit more defensive. And then we've just hung out below the 50-day moving average here for quite some time. It was looking to improve, but not after Friday's downward move with the S&P. And inflation, this is the one that still is showing us that we should be concerned about inflation. I don't want to just throw it out the window, but at the same time, we're not seeing confirmation of that, either in the government reports that we have received up to this point and other charts that we look at as well. On top is a monthly chart of the CRB index, actually dropping below the monthly moving average here, but the moving average is still going up. But when you look at this inflation deflation ratio, this is put out by Martin Pring, and I use a lot of charts that he has as well, but we see this really going up and continuing to go up. But again, we're not seeing that in other areas, but we still want to keep an eye on this. And here's the daily chart of the CRB index, just chopping along sideways, dropping down below both moving averages. And then dropping down a little bit below the 50-day moving average with the Baltic Dry Index. This is another inflation gauge. As a general rule, when this is going up, that means that it costs more to ship products in the Baltics. And when it's going down, that tends to be deflationary. But even though this is in an uptrend, it's not really going up with an awful lot of conviction. And now it's actually starting to pull back. Inflation expectations. What does the market think? Really haven't changed that here with this ETF. Just kind of chopping along sideways. Then we look at inflation expectations and look at a ratio with tips. If the market was really worried about inflation, we are seeing this going down a little bit. That means that tips are outperforming slightly. That's what people get into when they're concerned about inflation and interest rates. They're shorter term, they adjust for inflation, and you can like ride the interest rates up and get a better yield in tips. Well, when interest rates finally top out and start to come down, you don't want to be in tips. You want to be in either 1 to 3 year bonds, 2 to 7 year bonds, 7 to 10 year bonds, 30 year bonds, what have you. And then we see this ratio actually going up a little bit here, but this has been trailing up. It's still not really breaking to the downside very much. All right, then other markets, aluminum, which has been going back up and is just starting to give us an uptrend now. We've seen enough of an upward move. Now we'll keep an eye on this. If this keeps going up like it did in 2021 and really spiked up in 2022, this is when the market was very concerned about inflation. It's been more subdued lately. Corn also can be inflationary, but it's still in a downtrend here, and we're still in a downtrend with wheat. And fertilizer, this still continues to come down, even though it had been going up. Lately, it's been pulling back. That's not inflationary. Lumber, just kind of timber all over the place here, not really showing much conviction either way. We see some weakness and we see a little bit of strength, but overall, we continue to be in a downtrend. Then oil, which I follow this again mainly for geopolitical reasons, but we also just want to keep an eye on this because there are oil companies and oil can go up and the stock market can go up at the same time. We've seen a bit of a decoupling of that over the last number of years, but when things start to escalate in the Middle East, especially, oil has a tendency to really go up. Well, we have the peace deal that's being worked through, and that is driving the price of oil down, and we're actually in a downtrend currently. We're in the high 50s where we had been in the 60s. We're seeing a pretty strong correlation when we look at oil, which has been going down, and the 10-year yield, which has been going down. And so when we get a high reading like this, that means they're going in the same direction at the same time. Gold to oil ratio, gold's been going down, or excuse me, gold's been going up, oil's been going down. That's why we're seeing a bit of a breakout here with this ratio. And then gas in a downtrend and continuing to decline. Heating oil, which is hanging on to just barely being in an uptrend here, but really chopping sideways recently. Then natural gas, also in a downtrend, but starting to bounce back up. And diesel tends to be drifting lower overall recently. Then copper, another barometer of the economy, it got hit hard on Friday. It was down over 6%. Everything got sold on Friday, which leads us to believe, okay, was all of the craziness taken care of on Friday, or are we just getting started with the craziness? But overall, we're continuing to go up with copper, which tends to bode well for the economy. Copper to gold ratio, copper went down, gold's been going up, and we're seeing a continuation of this ratio going down. Longer term, the black line, that's the ratio, which has been declining. Also, going back to the beginning of 2024, we've also been seeing the 2-year yield and 10-year yield continue to drop off. Gold, that's kind of where everybody's at right now, but it's becoming very overbought. If you look in any technical charts here, it came down on Thursday, but then it ended up going back up on Friday. And silver also doing quite well these days. Then we look at a gold to silver ratio. When this is going down, that means silver is actually outperforming gold. And it's quite a bit cheaper. And so that might be more attractive to some folks that they feel that, okay, I can't really buy an ounce of gold. It costs too much right now. Why don't I jump into some silver instead? Well, this ratio going down, and then we look at that with the US dollar index, which has actually been bouncing a little bit. And that's another thing we want to keep an eye on. And I'll address that more here in a moment. But we're actually seeing them going in opposite directions. The gold to silver ratio has been going down as the dollar's been going up. That's why we're getting a very low reading with this correlation. Then here is the dollar. Now we're far from being in an uptrend. This is a daily chart. We've got a long ways to go just to get back to the moving averages. Now the short-term 50 50 period moving average in purple here, that is leveling out a little bit, but we're still going down with the 200. We're going to have to get back above both of these moving averages. Another kind of critical level would be the 100 level for the dollar. If it can get back up there. Now, if this continues to go up, this could pressure stocks. You can see as we've been coming down, now we were going down even before we hit the lows in April, but a continued weakness in the US dollar index has really been helping stocks to go up. Stocks like a weaker dollar, and it's been weaker and it's still one of the worst performing assets We've got oil back on the list now, but it just hasn't been performing all that well in 2025. Then we look at the euro, which has been pulling back a little bit when we compare it to the US dollar index. The one that's getting ready to change, we're just about ready to see a death cross with the Japanese yen to the US dollar. We're not quite there yet, but it's been starting to underperform, where the euro is still in an uptrend compared to the dollar as the dollar's been going down. So here's the euro. Now, we did see some weakness. It's falling under its 50-day moving average. We've been here before. We'll see if we get back above that. If this continues to decline, that means the euro's going down, the dollar's going up, which could end up pressuring stocks. This is the one that's really close. We got the moving averages pretty much right on top of each other. And we've been going sideways with the Japanese yen after really hitting a high back in April, and it's just been drifting down for the most part. This is the one major currency that actually looks like it could be shifting in its overall trend. And the British pound also pulling back, but still in an uptrend compared to the dollar. Then different ratios here. This is the equal weight version of the S&P to the weighted version of the S&P. When this is going down, that means the equal weight is underperforming. Now, there's other charts that show the equal weight's holding up a little bit better, and we're just coming off of recent all-time highs with the equal weight. But we're looking at a longer term ratio here, just showing how the large caps really continue to outperform. This little closer here, this is the weighted versus equal weighted version, where we really came down with the weighted version. That's the bar chart. We also declined with the equal weight. Everything got hit on Friday. And stocks are still outperforming commodities. So this kind of goes against that inflation chart, the inflation versus deflation. We're seeing stocks outperforming commodities. This shows how commodities are underperforming stocks. Then the Nasdaq 100 pulling back compared to the S&P. Both got hit on Friday, but in the bigger picture, we're still seeing this ratio going up, which means that growth is outperforming. Growth is the Nasdaq 100, where the S&P is more of a balance between growth and value. But the biggest stocks in the S&P are also the stocks that are in the Nasdaq 100. So this still overall is showing us that growth is outperforming. The S&P 100 pulling back, but still outperforming the rest of the S&P 500. The Nasdaq is outperforming the S&P 500, and we're still seeing the Nasdaq 100 underperforming. Now, we could be leveling out here if we're getting set to go down. Now, the big stocks, they tend to go down quick too. But if we're seeing some weakness coming back in that'll take over in the rest of the NASDAQ composite, we might see this ratio going back up. And as I've been trying to point out, this ratio going down, you could take that as negative, meaning that the big stocks are underperforming a broader index. You could also take that as positive, meaning that, oh, more stocks are participating, and that's why the NASDAQ composite is outperforming the NASDAQ 100. Small caps just they show a little bit of promise and then they fall back and they're really underperforming the S&P. This red ratio here, we were bouncing back up with the small caps. Now it's not following through. When we look at that compared to the blue index here, which is the S&P 500, small caps continue to underperform the tech sector. Mega cap did get hit, got hit over 3.3% on Friday, but still above the moving averages and still in a solid uptrend. Mega cap growth is still outperforming the equal weight version of the S&P. Robotics and AI ETF, this was actually showing some improvement. Not back to previous highs, but it was looking much better. It got hit on Friday, and it was starting to outperform a little bit, coming back up into the rainbow when we do the ETF ratio with the tech sector. Well, it came down a bit in Friday's session here. Now, semis look like they were doing a lot better. We were setting all-time highs with the semi indexes that we follow, and there's an ETF that we follow. And so when this is going up, that means semis are outperforming tech. Well, it got hit pretty hard. It actually came down on Thursday and then again on Friday. Dow Jones Composite, which is the Dow, the transports, and the utilities. Utilities have been coming on strong. The Dow's just coming off of an all-time high, but the transports have been going sideways and everything got hit on Friday. Low volatility, just chopping along sideways, but still hanging on to being in an uptrend. If the market was getting ready to be more defensive, we would likely see this go up. But at the same time, the market's been more offensive and this has continued to go sideways. Where we get some insight is when we do a ratio. The low volatility ETF, which are more defensive stocks compared to the S&P, this ratio is going down, even though it came up a bit in Friday's session. All world taking out US stocks, looking pretty good here, just setting all-time highs, but now retracing down to the 50-day moving average. Where this underperforms is when we put US stocks back into the mix. They were looking better, but you can see continuing to underperform. Energy is underperforming the tech sector. And then we look at tech to the 10-year yield. This still shows how tech is outperforming the 10-year yield, especially with the 10-year yield going down. This also shows an inverse of that. The 10-year yield is underperforming the tech sector. Growth taking a bit of a hit here when we compare it to more conservative bonds. But this big move down is the flight to safety that we saw on Friday, similar to what we saw last spring. People were getting out of the stock market, going into the bond market at fear, because we don't know at this point, was this just an announcement and it freaks the market out for 1 or 2 days? Or is this the beginning of a more substantial decline similar to what we saw last spring? And discretionary, taking a bit of a hit here. This had been a stronger area when we compare it to staples. Now it topped out and now it's starting to come back down. So it's still in an uptrend longer term, but we're seeing more shorter term weakness. Staples had been underperforming discretionary, but now starting to bounce back up. And gold, which is continuing to go up, and the S&P, which got hit on Friday, this ratio just goes up when that happens. And then gold to the dollar. Now, the dollar's been coming up a little bit here, so this ratio had been trying to slow down, but gold is still doing quite well and outperforming the US dollar index on a ratio basis. So here's traditional Dow theory, where we did set a recent high here with the Dow, and now we're falling back. We're right back down to the 50-day moving average with the Dow. That might be one area of support that we're watching. We're not very far above it with the S&P. There's also the Nasdaq and Nasdaq 100 and some indexes. We're seeing more of a convergence of moving averages and support levels that are coming together. And as this upcoming week plays out, we'll see, does that support level hold, or are we going to break through that? And that could signal that things might be getting more negative. And then transports. They weren't doing much of anything anyway, but they still had to go down on Friday with everything else. And then utilities have been breaking out to recent all-time highs, but also pulled back on Friday. Then we are seeing a little bit of weakness coming into the advanced decline line studies. We're down below the moving average with the NYSE common stock. We dropped down below the moving average with the S&P. We've been seeing continued weakness now with the mid caps and the small caps. And when this goes up, that means the Dow is outperforming the transports. And here are the transports, just kind of and just falling off a cliff here. It's like they're not really participating as much in the up move, but they'll sure go in the down move when this happens. And really underperforming when we look at the transports to S&P ratio here. Now here, coming off recent all-time highs with the S&P and now pulling back. Coming off of recent all-time highs with the Nasdaq, now pulling back. Then breaking this out here, looking at the S&P to transports correlation. This actually should have been previous chart here, where both are going down now. So we see the correlation actually getting a little bit stronger. This is the chart I thought we were going to get. Recent all-time high with the equal weight S&P 500, but now pulling back. And then recent all-time high with the QQQ equal weight, but now pulling back here. The Wilshire did decline. We're going to be watching this. This is a broad market measure. We're going to be keeping an eye on this 50-period moving average to see if that's an area that holds. Also, coming back down to the 50-day moving average with the total U.S. stock ETF. Just hanging out above the 50-day moving average with the FANG index, and these are the really big stocks. ARC still is doing pretty good here, even though it got hit 5.61% on Friday. And the NASDAQ Composite, broad market here, coming off of recent all-time highs, now coming back down to its 50-day moving average. All stocks, which are U.S. and international stocks, still looking good in the bigger picture, but pulling back right now. High leverage loans saw a little bit of weakness here, coming back down close to its 50-day moving average. But longer term, this is still in an uptrend, and this also is another barometer of the economy. If this is going up, this part of the market is anticipating that things are going to be okay. Bitcoin also getting hit right now, came down to its 200-day moving average, even though it's continuing to be in an uptrend. Microcaps just coming off of setting recent all-time highs and now pulling back. Emerging markets Recent all-time highs, now pulling back. SMH set an all-time high this past week and now pulling back. This also shows how we're coming down, but we're still above the rainbow, and all the lines in the rainbow are still going up. Then AI and tech ETF, again, setting an all-time high, now pulling back. Japanese Nikkei still going up. It was down over 1% on Friday, but it's just starting to, it had been setting a series of new all-time highs. We look at the S&P and the Home Builders ETF, still a pretty strong correlation as both have been seeing some recent weakness. And then longer term, US to world stocks here, still above an advancing moving average, still trying to go up here with the PPO longer term. So we're starting to roll over and see a downtrend in China. Emerging markets are starting to roll over. We're in a downtrend in Europe, trying to stay in an uptrend here in Japan, and could be rolling over here in the US when we look at the S&P. This is different though. This is a longer term oscillator called the KST. Then bonds really went up in that flight to safety in Friday session. This is the 7 to 10-year bond based on price. Total bond ETF still in a solid uptrend there. Rolling over a bit with the monthly chart of the stock to bond ratio. That's because bonds were up, stocks were down. This won't be completed until we get to the end of October. And even though we're bouncing up a little bit here on the daily side, in the bigger picture, bonds still continue to underperform stocks. Then junk bonds also coming down, seeing a little bit of weakness. They got hit with everything else on Friday. And this is praying the same person that does the inflation deflation ratio also developed this index as well. And world bonds are still pulling back now, but still in an uptrend. Corporate bonds looking pretty good right now and in an uptrend here. And we look at a stock to bond correlation where, especially after Friday's downward move with bonds going up and stocks going down, we're seeing the correlations starting to show that they're going in opposite directions from each other. Then more conservative bonds still looking pretty solid here. Junk bonds coming back down to its 50-day moving average. And then we look at junk bonds versus government bonds, seeing a little bit of a breakdown here, but longer term, it's showing that junk bonds are outperforming. But we'll see if this weakness shows more follow through. Junk bonds tend to follow what the stock market is doing, so that can give us some insight as to what's actually happening. And not really changing all that much. When we look at junk bonds to government bonds here, riskier to more conservative, we're coming back up into the rainbow. But you see the rainbow looks like spaghetti right now. It's not showing an awful lot of conviction. 10-year treasury yield is coming down. We're getting closer to that 4% level. And we have been coming down recently here with the yields across the different maturities. Keeping an eye on the 10-year yield in Japan, it's continuing to go up as their market is going up. This is what caused all the problems a year ago when the Japanese 10-year bond really started to go up back here in August of 2024. Well, it's continuing to go up. Doesn't seem to be a problem. The market's not really all that fixated on it. We'll just keep an eye on that. Looking at the volatility of stocks to bonds here, pretty high correlation. We typically have been seeing volatility of bonds coming down. That's the move index. Well, now we're starting to go back up with the volatility of stocks. That's the VIX, but it hasn't really changed the overall correlation. They're tending to move in the same direction as far as volatility. And then we look at some ratios. S&P 500 to short-term bonds, still looking good, but pulling back a bit into the rainbow. You're going to see a lot of that here. And this is an inverse of 3 to 7-year bonds to the S&P, underperforming, but bouncing back up in Friday's session. Also, the S&P 1500 to short-term bonds coming back down a bit into the rainbow. Broad market measure with 3 to 7-year bonds back down into the rainbow. Tech sector to 3 to 7-year bonds back into the rainbow. And then stocks to the 10-year yield. Stocks are still outperforming. And okay, why am I seeing this? I don't know why I have this chart here again. Maybe I missed it before. Yeah, that was a week ago. Okay, and then a long-term look here at the UST, which is the long-term bond, trying to come back up here and cross back above its moving average. When we look at a bond to commodity ratio longer term, we're trying to see the bonds improve over commodities, which also kind of goes against that inflation deflation ratio that we're a bit concerned about here. Now the different sectors, materials coming all the way down to their 200-day moving average. They're in an uptrend. Are they going to be able to bounce off of this, or are they going to break down below this support level? But when you compare it to the S&P, still underperforming. Communication coming down to their 50-day moving average. This has been one of the stronger areas of the market, but you can see this trailing off that we've been seeing over the last month or so here, especially as we started to get into October and coming down almost to the 200-day moving average with the ratio of communication to the S&P still in an uptrend but going sideways here. It was starting to break out in August, but since then has been pulling back. We'll keep an eye on this one. Energy, which is in an uptrend, but just getting hammered right now, dropping below its 200-day moving average. And longer term, it's still continuing to underperform the S&P. Financials, still a concern that we've been watching this next chart for months now. So it got hit pretty hard, fell down below its 50-day moving average and continuing to underperform the S&P. The only reason this went up is the S&P went down more than the financial sector on Friday. Industrials still in an uptrend, but now falling below its 50-day moving average. And we're just about ready to see a death cross here with industrials to the S&P. They had been doing a lot better. They started to top out. Now they've been coming back down. Tech sector really doing well, really strong, but it got hit over 4% on Friday and still holding up fairly well in one of the better performing areas when we compare it to the S&P. Staples, which had been going down, that means the market is getting less defensive here and still continuing to underperform when we compare it to the S&P, but we did see that spike up. It was the only sector in Friday's session that closed up, and it was barely up. And real estate, really sensitive to interest rates, coming back down, falling below its 200-day moving average. Now, at some point, if interest rates continue to fall, that might actually help the real estate sector, but it didn't help on Friday and really underperforming when compared to the S&P. Utilities just breaking out. They also got hit on Friday, but just coming off of an all-time high and actually really starting to outperform the S&P, even though it's still in a downtrend. Then the S&P to utilities ratio, this has been going down for the most part lately, which means the S&P has been underperforming utilities. Healthcare, a defensive area. Again, there was an announcement week before last where there's some kind of an exchange, and that seemed to really help the healthcare sector overall. We want to keep an eye on this. It's still in a downtrend, but this is a defensive area, and if it continues to show more strength, that could be a concern, but it has a long ways to go on a ratio basis just to start outperforming the S&P. Discretionary, which had been doing quite well through August and even into September, now seems to be pulling back and is falling below its 50-day moving average. Also seeing a bit of a breakdown here with the ratio between discretionary and the S&P. Semiconductors, recent all-time high, but now pulling back. And Dow Jones Semiconductor Index, also recent all-time high, but pulling back. The semiconductors to Dow ratio still looking pretty solid here, well above that blue line. So we have gold up over 52.5%. Stocks, which were doing better, but then they got hit on Friday, but they're still in second place. We're seeing bonds based on price going into third place, and commodities, that's the purple line, actually coming down. And the dollar, which has consistently been underperforming, now we're seeing oil actually starting to underperform even more. Correlations here between the S&P and the dollar, neutral right now. Not we've been going up with the dollar, and we were kind of going up with the S&P, but then we fell on Friday. S&P to oil, slight tendency to go in the same direction, which right now appears to be down. And then the tech sector to the 10-year yield, slightly coming out of the neutral area and going in a little bit of the same direction, which for right now is down. And then the S&P to the 10-year yield, a little bit stronger conviction as both have been declining. And then stocks to the 2-year yield coming out of being neutral and starting to go in the same basic direction there. Then some long-term charts. The NYSE Composite monthly chart rolling over here now, but still above an advancing moving average. And the Copic curve, which was trying to improve, is still in a longer term downtrend. And this rolled over right at the beginning of 2025. The NYSE Composite monthly chart here too, and we're still going up even though we pulled back a little bit with the NYSE record high index, still trending higher here with the S&P longer term. So we really haven't done a lot of damage that way. And then we do a stock to commodity longer term ratio. And we've actually been turning back up here, showing that stocks are outperforming, at least trying to outperform. They're still underperforming, but it's trying to improve here when we compare it to a monthly chart of commodities. Then another global look here, it's US to world stocks, still above the moving average, but continuing to decline with the KST. Then here's all the positive things, which if you've watched this recently, there's been no changes on this chart. Right here, we go all the way down to Bitcoin. And then the dollar index, that is the only thing that's negative right now, but we could see a death cross with the Japanese yen to the US dollar. Thank you. I hope you're having a wonderful weekend, and I will talk to you in the next video.